at the Center on Global Energy Policy at Columbia University, and Mr. Jorge Montepeque, President and Founder of Global Markets. Thank you, gentlemen, for joining us this morning. As usual, we like to kick off on Sunday with sort of a brief review of how last week ended on the energy markets. We saw stocks build, we saw China's imports down again month on month, and year on year, I believe in September, 18% down on last September. Jorge, I'll go to you first. Why are we seeing oil prices then healthy and supportive?
Well, there has been a narrative and a behavior in markets that has now been going on for almost a year. And if we take that broad view, inventories are being consumed daily. Demand and consumption is exceeding supply every day. There is the odd week when this doesn't happen, but on average, every day we have been consuming inventories at more than 2 million barrels per day. We are now at a level below the 5-year average and the low of the 5-year in general all over the world. So as we consume these inventories, as demand continues to surge, it is extremely natural for prices to react upwards. And this is a situation that is happening not just in oil, it's happening in so many commodities across the world. Supply chains have been disturbed, and a lot of money has been essentially created out of thin air by many central governments, and therefore demand has remained strong and the productive capacity has not remained strong. There has been clear supply chain disruptions, and there has been an issue with policies by many governments that have discouraged investment into key industries, such as coal for productive capacity of electricity. Gas is a little bit constrained in some countries in terms of exploration. So we are paying that price. And in the way I have been presenting this narrative in your program now for a few weeks, is that the situation is going to continue and that we are going to hit several key points, one after the other. We hit 70, 75, we have hit 80, and we are going to hit probably the next level, which is 100. And nothing has changed in the...
Okay, yes. Just to interrupt you there, how soon do you think we could hit 100 in your opinion?
In the way I see markets, and there is a caveat here, if the winter is a little bit cold, we will hit 100 between December and January. And okay. I have seen no change in that narrative, an upward incline that tells me that we won't hit 100.
Okay. Let me just stop you there for now. I'll come back to you. Christoph, same question to you really to start off. You know, we're seeing slightly contradictory signals here. We're seeing stock builds, China, huge demand center, weakening its imports, and yet oil prices being supported. Jorge just said we could hit 100 in December, January. Is that because of gas or because of fundamentals in oil?
No, I mean, you must know that Jorge and I had differences on this in the past, and I got a lot of flack from friends when oil went over 80 and said, see, Jorge was right, and said, no, he wasn't. Because the difference is not, you know, in denying that he was right in sort of being too quick in denying price spikes like we see now. The difference is also in the explanation. For me, the oil price increase has a name written all over it, and that's OPEC+. There is no systematic shortage of capacity. There is a systematic shortage of the willingness for political reasons to release that capacity. We still have almost 5 million spare capacity. Also on the demand side, I would be very careful. We have long reached now GDP levels of pre-COVID times again, but demand is not back there. And what we see in inventories is what we see in the best recorded places of the world, that's OECD and in particular the US. We do not see China or Asia or those regions where the actual growth comes from, where we know that probably the inventories, they are now declining because they can compensate, they can replace imports to some extent because they went on a big shopping spree when prices were so low. What I want to get at is that it's very important to keep in mind that there is a systematic difference between the situation in gas, natural gas and coal on the one side, and in oil on the other. In oil, this is an OPEC decision, and it looks to us like a very strong price rally, but it's actually nothing compared to what happened with the other fuels. In oil, we have hit 70 in March last year, and then we have hit 75 in, I think, July last year. Now we are above 80. But if you allow me, I would like to share something with you, just to put things in perspective. And now, of course, it's Irene, could you put this up? What I sent you? It's gone from me. Okay. Look at this. This expresses pretty much what I mean. You have here the price increases over the last 6 months, if you put it all on 100. And you see Brent there at the very bottom. Yes, it blipped up a little bit, but what is that in comparison to gas? You know? Natural gas prices sort of doubled in March last year, and by now they are 5 or 6-fold, depending which regions you are. Even boring old coal has doubled. This is a very different game from what has happened to Brent. And for those fuels, Jorge's logic applies. These are fuels where we have seen an investment gap, a lack of investment. No one in his right mind would invest in a coal mine the last 2-3 years with all this talk about the energy transition. Gas was affected by COVID by many different factors, plus politics a little bit, but the capacity is in short supply there. And that's why these prices will continue running up, even if there are segments of the markets where this is probably an overstatement.
Well,
but for oil, it's an OPEC plus story.
I'll stay with you, Christoph. Let's keep that chart up there and just talk about gas before we go back to your oil comment. On gas, we've seen that, and again, we don't have any other commodities on that chart, such as agriculture and grains and other metals, which have also gone up in sort of an equal measure. But on gas, just to address that, Putin, coming to the rescue last week, saying that he will supply Europe for more gas if it needs it. Is that something that you think can calm markets down? And does Russia have the capacity to really do so in the short term?
So on does it calm markets down to some extent? Yes, it does something very important, psychologically important, which you have seen in the UK, not you, but UK people have seen with the petrol crisis. It avoids panic shopping, which could also even apply to industrial and utilities and industrial companies. And people think Russian gas is coming, then this will calm down markets in that sense. Preventing the actual creation of shortages by demand spikes caused by worries about unavailability. But does Russia have enough gas to satisfy itself? Inventories are 75% in Europe, and they are not much higher in Russia. So they're below the long-term average in Russia as well. And depends whom you talk to. Russians I talk to are adamant in saying that Gazprom is sort of flat out maximizing everything and can't produce more. But I suspect the truth is also when we look at the Yamal pipeline and the Druzhba pipeline through Ukraine, where imports into Europe have actually fallen. And at the same time, of course, Nord Stream 2 has been filled and is partially the same supply, is partially just an interconnector away. So it's also true that Russia now, of course, number one, waits for Nord Stream to come online, and then together with Germany, you will hear this chorus to the US, we told you so. And number two, trying to use that to turn back the clock a little bit towards long-term pricing, which is something the switch to spot prices, to competition, flexible markets dominated by LNG cargoes, which can go anywhere in the world, different from a one-to-one point pipeline. That's something close to the hearts of Gazprom people and of the president. And this attempt to switch back the clock and go back to long-term prices and this ostensible stability that we will hear more of as well. So it will calm down the markets, but not eliminate the prices altogether.
I mean, we have a story there on the bulletin today that's saying that European stocks of gas could run out, could go to zero very soon. So, they may be, absolutely completely dependent on Russia getting its act together if it can. Jorge, where you're sitting, just again, if you can give us your viewpoint on the gas crisis in Europe. You're in Spain, you said right now. I have family in Spain. They told me they had a power cut yesterday. I don't know if that's related to what we're seeing at the moment with gas, but give us your opinion on that. How much, is the strength that we're seeing in oil due directly to the gas hike, really, in prices?
Well, I think in the last session I had with your organization, I indicated that we should be ready for surprises in the market, that they were coming. And we haven't seen them all. We will continue to see this kind of situation. Gas is very short. I have a lot of conversations with my acquaintances in the market, and essentially we all feel that Europe has followed a very short-term and almost like thinking about a paradise where energy is long and cheap, and is realizing the error of its ways. Gas is very short. Governments have taken very short-term views that are not very good. In the UK, there is no proper storage of gas, so gas is going to react upwards. Spain has an issue with gas and the price of electricity. We need to wake up. There is a shortage of basic commodities globally. Consumption is very strong. Diesel demand in the US is higher than it was prior to the pandemic. We just see all these expressions everywhere. The planes that have flown in are fuller than normal. Of course, the capacity is lower. What is going to happen in the next 3 months as countries open up with flights? The demand for jet fuel is going to surge. We're going to see another kickback into the price of oil. But
so
as we head,
why haven't we seen OPEC Plus then act sooner with more oil? Christoph is confident they've got the oil to supply today. Why aren't they acting sooner and breaking the plan that they've got at the moment?
There are two sources of supply when you need it. One is inventories, another one is extra production, and maybe there is another thing, another source of supply. The other source of supply is cheap talk. We'll give you some. And that cheap talk, I think even Putin is guilty of that. It's not like Putin has extra gas that he can give to the Europeans. Nobody operates with a lot of spare capacity, bar the Saudis. All those things take time, a lot of time. I have seen now some indications of some oil companies refurbishing oil pipelines and trying to bring old capacity back into line. But again, these things take time. We are not ready for the end of COVID. And this is why we're seeing this surge. I think as an economist, and we all either, I guess in a way I pretend to be one, is we need to look at history and remember what happened in the Roaring 20s, when there was a specific time in history, but the economies came back and everybody got to party. And as they get to party, demand increases. And we are ready to go back to our old ways. I'll give you an example. Singapore is opening up and is accepting tourist visitors without quarantine from the UK, Spain, and various other countries. They made the announcement yesterday. As they made the announcement, the Singapore Airlines website crashed due to the extra demand. As soon as the website came up, we bought tickets because my wife is from Singapore and my kids were born there. Immediately we bought tickets to go. And we were on the phone with other friends who were desperately trying to book tickets. We all want to get back to normal. And this means a surge in demand because we all saved money during the period of the pandemic, the ones that had income, of course. And a lot of them were also supported by governments. So everybody's ready to go out, but it's not ready to go out perhaps to fully work, but to enjoy themselves a little bit.
Let's talk about work. Let me interrupt you there and talk about work. I'd like Irene to also bring up our survey question for today and look at the US a little bit. The jobs reports then, kind of let's switch to demand a bit from supply, and you've introduced us there. Let's talk about the real recovery that we're seeing or not seeing. There's your survey question. Despite the weak jobs total, the recent jobs report that came out, wages increased sharply. And the year-on-year rise is 4.6%. And so how is that going to affect the Fed's appetite to start tapering? and try and combat runaway inflation. Now, you know, the weak jobs total may have been a little bit, the weak report on jobs total may have been weaker than expected, but wages increased, unemployment is still improving. So really we're seeing an improving picture, Christoph, correct? Regardless of this week to week, whether we've gone up 100,000 or 200,000 jobs. Do people care though anymore about the jobs report in the US? I mean, is it going to really impact policy towards trying to tackle inflation, or are there much bigger problems from an inflationary point of view?
I mean, the job reports in the US have well identified weaknesses because they are really like that. They are reports. They're not the people, you know. It's a long story on the statistical side. It captures only those who are not dropping out of the system, which you do when you give up raising claims for unemployment money because you're not eligible anymore. So they always have been very volatile, and so markets have cared to some extent, but I think you're right, it's not playing that major role anymore. The reason is important. The reason is that I think tapering by now is largely priced in. And sometimes you see the little starts of a tantrum or so, not when the discussion cooks up. But tapering is the least of the US's worry. You know, there is a very awkward situation developing, which is around the whole Biden program becoming more difficult to implement. And in particular, of course, his own party in the way of implementing the stimulus program. So my best guess, and I think the market's best guess, is that at the moment, yes, the debt ceiling will be raised one more time. But even there, everybody knows at one point in time, it will not longer work like that. It did for the last 100 years and may for the next, but at some point it goes wrong. Then the markets obviously think the infrastructure program is going to come, may come, it may be scaled down, but it will sort of chipping away on what they can do. The important thing is what this adds up to. And Jose says we're all economists now. That would be good, because then we could recognize that we're seeing is a cyclical movement. You know, there is, and this is where we have our fundamental disagreement, I think, the longer I listen. There is plentiful of energy in the world, whether it's oil or natural gas or coal. There's no supply restriction. This is hogwash. There is an investment gap in those fuels where we haven't talked about investment gap, like like natural gas and coal. There is no investment gap. There is OPEC plus in the one fuel where we've discussed an investment gap ad nauseum in oil. So take this together and come through with this, which is true. Of course, there's a flash on the demand side. People want to fly and all these kind of things. Then you can see that you will have a supply response because the laws of economics still apply. This is demand destruction, the beginning of which we may be seeing in Asia. It's also what we've said numerous times here, that the US will come back, you know. With all respect to Scott Sheffield, you know, the laws of economics say that shale producers will start producing more. The rig count is going up already. Production is itching up. And by the spring, by March, April, we will have a rig count which allows for substantial changes in US oil production. And we will see even earlier a fixing of the natural gas situation in the US, because natural gas in the US is plentiful. Again, it's concentrated in 3 major fields, and it's basically bottlenecked by transport constraints right now, and that can be fixed in half a year's time. So I would expect the situation maybe to continue, especially in oil and gas, and then to be relaxed. It's a classical hog cycle, and then a year from now, we may all sit here and lament low prices. Whether that happens or not is to some large extent a function of the economy. And there we have this flash in the pan of the sudden COVID release, that's true. But whether this translates into durable, sustainable, long-term growth or not is dubious. The Chinese doesn't look good, Europe doesn't look good. The US looks good if Biden gets his way, and even that is a little bit doubtful, as we've seen.
Jorge, we see the results there, everybody. Yes, the Fed will start to taper despite the 4 jobs report, and I think it's going to taper anyway, regardless of anything, just for show. Just to stick to the inflation argument before we move, I'd like to ask Jorge also about shale and his opinion on supply by second quarter of next year. But we've got company earnings starting to be released for the third quarter, soon. And you know, just to stick to this inflation argument and wage inflation. I mean, we've seen, you know, wages rising, right? There's a lack of supply of labor who's at least willing to go back. How much of a concern is this, Jorge, in the inflationary argument? And you know, is that how much of a wild card is it going to be for companies recovering in the fourth quarter?
It's a big, it is a really big concern. What we have seen is an increase in the monetary supply, very strong, in the last 18 months. And we have seen a decrease in the productive efficiency. So if you have those two things together, you have, in a way, constrained output going out and more dollars and money chasing those goods. So you're going to have inflation. And it takes time for the productive capacity to come in line and for the tapering to occur. I am sure the Biden administration is not one that is going to come in like Reagan did and put down the monetary excess supply. They're going to be slow in those actions. So I think we all need to be ready for our money to buy less. Everybody I know is complaining about the cost of goods. And I am sorry, I'm going to have to disagree with Christoph a lot. There is no surplus of energy. There is no readily available extra energy. We are seeing.
Okay, I said
about shale. A lot of people are saying shale, at these prices obviously should already be coming back more than it is. And it's projected that we're going to see healthy oil prices for the next 12 months, no doubt. So why aren't we seeing more shale come online?
We should, and we are seeing a slight increase in the number of rigs being added. But in the US, and you have to think very seriously about this, who wants to be a field worker in a dangerous area that may have gas releases when you're puncturing the ground, when you can get a job anywhere else? So all these industries that have what I would call heavy duty jobs are having a hard time securing employees. A, or B, they have to pay them a lot more. So the underlying cost of production is increasing. And this is going to reduce the ability of the world to come back fully with that productive capacity. So we're on a run right now. And there is nothing that will break that in the short term or midterm, short of strong government action to reduce the money supply and increase interest rates. That could put the party down anytime, but I don't see the willingness in any government to reduce the money supply and sharply increase interest rates because they would be voted out of office. So we're on a run.
Yeah, until we crash somehow at some point. Christoph, let's start to just look at the week ahead. Is there anything that we should be looking out for? Announcements from the US, outlook for the week ahead?
I don't know much about the week ahead. I haven't found any big significant things. There is political movements now with elections coming up, people stepping down. You just had in Europe, the Czech Republic, you had Austria. All of this, but you can see how it pales into insignificant if one looks at this big picture, how the triangle between Europe, China, and the US are sort of performing economically on the one side, and what happens with this energy and inflation situation, which suddenly, just like in our discussion, always are named together, rightly so, on the other side. And let me just for once not agree with Jose, but super agree with him on the inflationary side. It's not only that the Biden administration, for political reasons, will be slow in clamping down on inflation. It is also that all the collected Western governments and central banks deep down at their heart know that they have no chance of getting rid of the substantial debt which has been piled up, other than by gradually inflating away. In other words, every finance minister and his technical staff, every central bank and their technical staff, in their heart of hearts know that beyond the short-term inflation problem looms a much larger debt problem, and then they can actually, when they can get away with it, use one to cure the other, for which otherwise there's no hope to solving that.
And when are we going to see? When are we going?
And then on the energy side again, I mean, there is no shortage below ground. There's a shortage in productive capacity. That links to me directly to the energy transition and all this talk about not investing. But shale and others will come back, of course, because this is economics. People don't want in heavy duty jobs. Fine. So if the demand is there, pay them more, and they will. And that's what we will be seeing.
Okay, and any concern for the big banks, for example, who are coming out with their earnings? Just to stick to this inflation argument and wage inflation, I mean, we were seeing them obviously having record profits this year, big recovery, along with everything else. Do you think it's a concern for them in terms of their rising costs of running their operations?
Inflation has a nasty habit of starting sort of very gradually and almost by stealth and then accelerating along the way. Once it starts accelerating, the cure is already starting to become very, very painful. So people tend to wait until it has accelerated to almost double-digit levels or something like that. And that would require the kind of massive rate increases Jorge is talking about, and that would almost certainly stop the US and the European economies from growing anywhere close to where they're going today.
And Jorge, when do you think we could see any significant rate increases come in?
I think there will be, well, I don't know about significant, but they will start coming in definitely in 2022. I think the central banks have a responsibility and they will react to that, but they will react very slowly and cautiously because they're political machines after all, right? And I think there's going to be a big difference between the actual rate of inflation and the pace at which the interest rates start to rise. So my advice to everybody is don't be long currency, be long goods, because goods are good. Goods will continue to retain their value and will continue to gain value. So real estate will continue to be a good investment. Commodities are a good investment.
How at risk is the dollar for weakening beyond where we see the index today? I mean, what's your trajectory for the next 6 months?
From a very intellectual basis, the US dollar should decrease. But the US is the reserve currency, so it doesn't act normally. It has great rights, and therefore, I don't think it will.
Yeah, are its days numbered, Christoph? I mean, you know, I know we've seen Bitcoin and everything else and all the fintech stuff exploding, and that's, I think, going to continue. But do you think its days are numbered as a reserve currency?
I'm not sure I quite understood, but I think that the US is under the microscope for increasing interest rates. In a situation like that, the dollar tends not to decrease, even if there's inflation. And then, of course, it's true. It's the reserve currency. You see any wobbles in the financial markets, and nobody wants to hold yuan or rubles or even euros. Everybody wants to hold dollars, and that's their big benefit. But let me tell you something else. There is a little laboratory which we can observe, which may show us sort of the kind of game, the political game which is being played, and that's the UK. In the UK, you already have warnings now, the new chief economist of the central bank saying, we need to curb this, inflation is becoming too strong. And at the same time, you have, of course, a very more precarious economic situation than in the US or in continental Europe because of Johnson's policies and Brexit and all the rest of it. So there, we should see this conflict between the need for rate rises and the desire to not increase rates and to kill the economy break into the open, probably first among the developed economies.
Okay, and one last question to both of you. I think we did mention the word in this half an hour, but we've hardly mentioned it in the last few sessions, and that's COVID. And it seems to have not disappeared from everyday chit chat, but in terms of impact on energy demand, it certainly has disappeared. Jorge, let's have give you the last word on that, and what your opinion is on that, and you know, whether it's a concern on the supply or demand side.
I think the world is learning to live with COVID. And I think as we head into the holiday season for Christmas, most countries will open up. I see globally a lot of them taking the steps to reconnect and open flight corridors. So I think we're going to have a fairly normal Christmas. And that means that energy demand will go up, jet fuel demand will go up, that will backfeed into diesel. So I think the overperformer for the next quarter will be diesel relative to anything else. We need to be very ready for that. And I think as a whole, we are accepting deaths and infections and hospitalizations as part of our life. But I think COVID as an issue is behind us now.
Christoph, would you agree?
Yes. Yes, in principle, yes. And I think we make it a bit worse. So we are moving into this kind of bifurcated world where you have vaccinated people who really don't care about COVID anymore because the hospitalization rates and the fatality rates tend to be so low among them. And non-vaccinated people who are perceived as a drag on the social system in developed countries, and who are the majority of people and still dying and still getting sick in developing countries. So the poor ones are biting the bullet at the moment. With that addition, I would completely agree that for most of, pending no new mutation, which could happen under these circumstances, that the world will move increasingly out of the situation and learn how to accept it.
Christoph Ruhl and Jorge Montepecchio, thank you very much for joining us. We'll end on that positive note of both of you agreeing, and we look forward to seeing you in a week's time, hopefully. All the best and have a good week ahead. Thank you.
Thank you very much.
More interesting is not agreements.